Welcome, everybody. We're excited to have you here today on our quarterly market insights call. We do this in order to bring our client base up to speed on what our portfolio managers are thinking about the markets, the economy, and portfolio decisions. So important people here on the call. We will do our best. We have quite a few people on the call, so we'll do our best to make sure that you hear from the experts as much as possible. So today we have Tim Holland, who's the outsourced chief investment officer. That's what Orion is to us. So that's where you see the OCIO. That's the firm helps us with investment research, due diligence, narrowing down the field of investment options, portfolio construction, and trading and fee billing. So there's a lot that they do for us. And we spend a lot of time coordinating with and talking with every day, working with different folks at Orion. So big partnership for us. We really like what they do. And the investment philosophies align in terms of us believing that there's not a lot of value in high frequency trading. And we believe that you should own higher quality assets. And we believe there's benefits to low cost diversification. And then we also believe there's benefits to what's called semi-concentration. So all of those things come together. We talked about a lot of those things in the past. And we really like Orion for those reasons. So Tim Holland is the chief investment officer there. Ryan Dressel is the one sharing slides here. So Tim's video isn't working today, but no big deal. Ryan's video is, so who you're seeing here is Ryan, and then Tyson Williamson is Capita's director of investment operations. So every single piece of communication around what needs to be done in a portfolio passes Tyson's eyes before it hits Orion or comes back from Orion to one of our investment advisors. So he's a busy guy. He runs audits for us. He does due diligence. He calls managers, kind of holds their feet to the fire and makes sure that they have exact answers for what they're doing in the portfolios. And my name is Zacc Call. I'm the president of Capita Financial Network. My job is to help it grow and help you get the best experience possible. One quick thing I want to share, if you don't mind, I'm going to share my screen, Ryan. This is an exciting day for us. Today is the last day that we will be in this office. Let me show you what I mean by that. Can you guys see this map?
Yep.
Okay, so this is the Salt Lake Valley, and we are currently at 100 South in Sandy, and that's about right here is where we're sitting. We will be moving down south by the Pluralsight building. So this is the Pluralsight building right here. And where this red dot is, that's our view. So this is the exact lot on which our building now sits, and we move tomorrow. So when you come visit us next time, come check it out. It's considered Suite 300, but it's really one floor up. And then you'll be able to enjoy the nice views and come check it out. We're excited to have you come in. I just wanted to share that with you. It's been a 3-year project for us. So Ryan, if you want to start sharing again, I'll just finish that. But it's been a 3-year project for us. We've been out of space. We have advisors sneaking into different offices that are open whenever possible to be able to handle Zooms. Like, it's been a really wonderful growth experience, and we desperately needed the space and super excited about it. So that's all I have to get us started. Ryan and Tim, why don't you take it away, and then Tyson and I we'll do as much as we can to help keep us on track and things like that. And then is the other Tyson going to join us today, Ryan?
Yeah.
Right
Yeah,
now.
I'm just going to let you know. I think we're trying to get him on as a panelist. I think
I will watch for him in the list.
Yep. All right. Thank you, Zach. And thank you, Tyson. Thank you, everybody, for joining us today. I think we have some really important topics to discuss today and some very timely topics to discuss. As you see, the title of our slides we present today are called "The Fed Cuts, America Votes," and what a shift in monetary policy and an unprecedented election mean for markets and the economy. So those are some pretty heavy topics. We just had a 50 basis point rate cut by the Federal Reserve just weeks ago. And then, call it 4 weeks away, we have an election. So I don't think timing could be any better to join us today. And we thank you for taking time out of your very busy days to join us. Let me just make sure the slide clicks through here.
Tyson's in as well. So we've got 2 Tysons on, everybody. We've got Tyson Walker with Orion, Tyson Williamson with Capita. But this is Tyson Walker that just joined us.
All right, welcome aboard, Tyson. No time to catch your breath, but we're off and running. So we'll spend the bulk of our time today covering those 2 important subjects. But we also have Tyson Walker on, who is a senior portfolio manager, to discuss some of our portfolio asset allocation and review some SMA manager highlights for y'all to see how your portfolios are being managed. So Zacc and Tyson, I don't know how you want to do the Q&A. If you wanted to pause in between comments and take breaks along the way, we can do that. If you
I
think it's time
say
to do it
fire
at the
away.
end.
Every attendee, fire away in the chat and the Q&A. That's usually my job. I'll watch it carefully, and then I know I have your slides as well, Ryan. So if I can see that it's something we'll talk about later, I'll try to let everybody know when it's coming. But I find it's better if you engage. We want this
Sure.
to be for you. So tell us what you want to talk about as we go.
All right, I like it. All right, let's get into it right away in the interest of time. So the Fed cuts, are they too late or are they right on time? So we have kind of a teasing title here because many feared they were a little bit too late, but we'll explain why we think the timing of their cut makes sense, is justified, and is not the worst case scenario for rates and the economy. But to set the table here, the past 2 years, I think everybody on the call today knows what inflation felt like and looked like for those past 2 years. You can see the Federal Reserve raised interest rates to combat that, and they tightened monetary policy to slow down the pace of economic growth. And in doing so, they shrunk a bit of their balance sheet. So the good news there is that if we have any economic trouble coming down the road, the Fed is now better prepared to handle any of those challenges on the economy. They have more arrows in their quiver, so to speak, after this tightening cycle over the past 2 years. And the reason they were tightening is because they were fighting inflation. The CPI, which is a good measure of prices, went from 9.2% annual basis at its peak in 2022, and we got it down to about 2.5% or thereabout today. So that's a pretty noticeable high five from the Fed to a job well done to get that down without causing a recession so far, knock on wood. So that's kind of primarily what they were focused on. And they were doing that even though recession signals were flashing red. So the bond market did not like these sharp, abrupt rate cuts. The jobs market started to slow. Job openings decline. Credit card balances, things like that, started to balloon. The consumer got stretched. Manufacturing slowed. You had a slew of just indicators that said things were going to be bad, and they kept tightening. Perhaps a little bit longer than most expected. Certainly, we didn't expect them to go quite that long, but to their credit, they so far have staved off a recession. So then we got the big pivot. We saw inflation come down to a more manageable level. We got a 50 basis point cut to the federal funds rate, down from, I think, 5.25% down to about 4.75%, which is kind of the very, very short-term rate that big banks can borrow from our central bank. So that's kind of what that rate means. And then all the other borrowing rates beyond that, whether it be corporate or personal, are kind of tied to that rate. So that's why it's important to note what the Fed is doing in their actions. And after the 50 basis point cut, Fed Chair Jerome Powell used the word recalibrate repeatedly. And what he was meaning there with that comment is that we moved policy down to a much more appropriate level that reflects the fact that we still have very full employment. And now inflation and prices are much more moderated or reasonable or stable. So that's why he used that word. And I think it does make sense because a super high interest rate with those two boxes in check doesn't necessarily make sense. And they can kind of take their foot off of the gas, so to speak, with their tightening. So directionally, they're moving in an easier rate for the economy and for markets. And there's more cuts probably to come, right? So the Fed guided another rate cut to finish the year. If you look out into 2025 and 2026, if you sample the poll of Federal Reserve voting members who get a say on where rates go, they think that rates are also going to go lower over the next couple of years as well. So this is not just a one-time cut. If you look at the history of stock market and the bond market and the economy, a cut is generally okay or pretty good for stock returns. On average, stocks have risen about 67% of the time in 12-month windows after a major rate cut. If you go back at least 40 years of data to look at that. So that bodes well as long as we don't get a recession. So if you see in that right column, the average return was about 11.3% for that 12-month period after the first cut for stocks. But some of those negative numbers are pretty pretty sizable. And the reason we got those numbers is because a recession followed. So that's the key: is to have the rate cut be precautionary without a meaningful recession to follow, and you'll do pretty good. You'll do even better for fixed income and bonds. The average return there is an eye-popping 13% for the 12-month window after a cut, and 100% of the time, bonds have been priced higher. On the economy, we've avoided a recession. I'm sorry, we've entered a recession 58% of the time, 12 months following a cut. So generally, the Federal Reserve likes to cut rates, but it's also problematic because they see something that's breaking in the economy, and that's why you get recessions. In this instance, we don't necessarily see that right now, and we think it's more precautionary than reactionary. So we think we have a good chance at staving off a meaningful recession, and even if we do get one, we think it'll be a bit shallow.
Hey, Ryan, I'm gonna
Yeah.
make sure that because the question is exactly what you just said. So I want to make sure that we hit that. So the question was, is the recession over or still to show up? And so from what you're saying there, it sounds like we believe that we are not likely to enter a recession based on this activity. And if we do, it'll be smaller. Is that right?
Sure. I'll skip ahead a couple of slides and then we'll come back because I think we have some slides that really address that. So if we flip ahead here to this slide, we call out some things that really give us some confidence that we're not headed towards a 2008, a 2001, or something much worse than that. And some of these reasons, and we can't fit them all on the page here, but if you look in the upper left here, the Federal Reserve does an annual stress test to the banking system, and the 31 largest banks are kind of scenario tested to see what would happen if we had a severe economic downturn. And they look at their books and see what would happen, and all 31 of them passed. So we're in good shape. The system and banks are behaving responsibly. If you look at the bond market, you haven't seen credit spreads blow out, and that's usually a signal when they do blow out that the bond market is really nervous about economic conditions. And we don't see that right now. So this chart that we have on the upper right shows high yield bonds, which are really risky bonds. And when the line goes down, it means that you're not getting paid a lot to own one of those bonds. And when the line goes up a bunch, you're seeing investors demand higher payment or higher yield for owning such a risky asset. So when that line moves down, it's a vote of confidence for the bond market to say that conditions are pretty good right now, and you'll get a high chance of being paid back money lent.
So Ryan, real quick, knowing the way most of us understand the finance world, I'm just going to do a quick explanation of that, just so everybody feels comfortable and knows what's going on here. So credit spread, think of like treasuries, think of government, US government bonds, think of them as like the most conservative thing you could buy. And let's say you got 4% interest on a particular maturity or particular length of that bond lifetime. So let's say it's 4%. But if you wanted to go buy a bond that pays more, let's say from a company, ABC company, and they're paying 7%, that's a 3% difference between a risk-free interest and a risk interest. And so the difference is what they call the credit spread. You're getting that spread for taking on the credit risk. That's why they call it the credit spread. So anyway, this is what Ryan's showing you in this top right chart. If you can put a decimal after the first number on the left, like instead of 650, it's 6.5, or instead of 600, it's 6%. Bond traders think in what's called basis points, but those are 2.5%, 3%, 3.5%, 4%. So the idea is if you wanted to, if in 2022, if you bought high risk bonds, you were getting paid 5 to 6%. But now you're only getting paid 3 to 3.5%. What that tells you is that people are less concerned about those businesses going under and not being able to repay their debt.
Very helpful explanation, Zach. Very helpful. And just for reference,
some of us have a hard time keeping up with you, Ryan, and I think this
I just want to make sure we save enough time for Tim.
Yeah, you're good. Sorry, keep going.
Here. So that's why I was going probably a little bit too quick. But for reference, that chart was off of the page in 2008 and 2001. So for reference, we're really, really low in terms of spreads, and that means a vote of confidence from the bond market. The other visuals we have up here in the lower left is corporate liquid assets. So that's just how much cash companies have on their balance sheet. So they're very well positioned if anything does go wrong and they need to refinance or raise capital, they're in great position to do so, or even expand their businesses more than they are at present. And then on the lower right, we show S&P earnings per share, and the year-on-year growth change there is directionally forecast to keep going higher than we saw in 2023 and 2024. Forecasts are for double-digit earnings growth. There's some other things I could throw on here, like kind of the wealth that was created post-pandemic. So everyone's in pretty good shape in terms of accumulating some gains to fall back on if we do have some hard times. Similarly, the housing market's in pretty darn good shape as well too. So there's a bevy of data we could put on here to show we have a lot of confidence. But all we're trying to show here is that there are a number of indicators that we see that are a good backstop that provide a lot of confidence that even if we do have a slowdown, it will be pretty well balanced and short-lived. So let me just go back a couple. We covered what's next for stocks and what's next for bonds and what's next for the economy. Some are worried that the Fed is a little bit too late in their rate cut. So we had some volatility in August with some sharp sell-offs for stocks. And the reason there is we got some really scary numbers around jobs. Had a revision that showed that there were much fewer jobs added than previously reported. Some other indicators that flashed concern that the Fed was a little bit too late in their rate cut. Now we're, in more recent days and weeks, we're actually seeing the opposite of that. And that, some folks are feared that we might need to slow down the pace of cuts because, again, we got some better than expected jobs data. So the key takeaway on this slide and in the next slide or two here is that the Fed is really shifting away its focus from inflation because they checked that box and they did really well there to bring that in. And now they're shifting their focus towards the labor market. What they don't want to see is a blowout in job losses and have to go combat that problem as well. So that's kind of their dual mandate, is to make sure that our U.S. economy has full employment and stable prices. So they're kind of changing gears, if you will, in terms of what we're looking at and where the next target is for the Fed.
And the distinction there, real quick, one thing to add there, Ryan, is the Fed is not focused. Their goal is not keeping us out of a recession or even a mild recession. That is not their goal. Their goal is keeping inflation in check and keeping the unemployment rate low. That is what they're focused on. And in the grand scheme of things, for long-term investors, that's the important thing. Minor recessions happen throughout market cycles. It happens. It's a regular thing that happens in the markets. Investors, if you're a long-term investor, you shouldn't be too worried about mild or small slowdowns in the economy or in the markets. The things that are concerning are the things that the Fed is actively combating, like inflation, right? So when Ryan says they've shifted their focus to be more on the job market, I mean, it's like a job well done. The Fed is coming out and saying, hey, pat myself on the back. We did it. We handled the inflation issue. We're moving on. And so it's a very positive thing for investors, especially long-term investors.
Very well said, Tyson. And the Fed also doesn't care about the stock or bond market too, just to point that out. So they didn't care in 2022 when stocks were selling off sharply, and they certainly didn't care in the past 18 months when you had the recovery and big move higher. So those are the two key focus points that Tyson elaborated on there. So let me pause there just to recap real quickly. The Fed cut, interest rates are going lower, borrowing costs are improving, the economy's in pretty good shape. Even if it stumbles a little bit, it will probably be short-lived. Stocks and bonds have a good history coming out of that rate cut, and we think a soft landing or even a no landing scenario is very likely for the economy, meaning growth will continue to move in a positive direction over time. So let me just pause there, see if there's any other questions that came up in the chat before I
There was one. Yeah, there's one question that talks about if the job growth is government jobs versus private sector, does that impact the outlook?
The Fed looks at everything. I think the private sector is more important to them. That's certainly a much bigger piece of the pie. So we certainly value that more than government jobs as well.
That's it. All
righty. If you are able to see the slides up on the screen, I know you're dealing with some IT problems with your camera, but we have the slides queued up here for what's next for the election and what it might mean for markets and the economy.
So we've got the Fed, right, the September 17th rate cut and what it might mean for the markets and the economy. And Ryan just did a great job speaking to all of that. I think the questions have been fantastic and super relevant. So we'll just spend a few minutes talking about the election. As I sit here, it's October 8th. We're less than a month out, right? Tuesday, November 5th. Some folks have obviously voted early. So the clock is winding down. Going to tell you a lot of stuff you already know, but hopefully there's some good context and perspective there. The first would be this election was going to be a big deal even before the horrific events in Butler, Pennsylvania, and then the second attempt on Donald Trump's life and Joe Biden deciding not to seek a second term after all. It's only the second time where a sitting U.S. president has been challenged by a former president. So we live in interesting times for sure. And then obviously Kamala Harris stepped in as Joe Biden stepped away. And here we are with about 25, 26 days to go. If you go to the next slide, markets are up. This slide's a couple of days old, but I think as we sit here, the S&P is now up a little north of 20% year to date, maybe 15, 20 points off its all-time high. I know the market's been volatile the last couple of days. The Middle East, the spike in oil, some other sort of macro concerns. Markets do tend to do well during presidential election years. The way I think about that is I go back to a great Tom Clancy movie, Clear and Present Danger, where the evil chief of staff tells the evil national security fella that this first-term president wants what every first-term president wants, and that's a second term. So at the risk of sounding cynical, if you are president and you're looking for another 4 years, you're probably going to do whatever you can to stimulate the economy, corporate profits, and hopefully risk assets so people feel a bit better about your leadership. And if you are already winding down your second term, you most likely want to create a backdrop where your party's nominee, your successor or potential successor, has a better chance of winning the big prize. So not surprising that markets are up year to date, we've got a couple, a little more than 2 months ago, but 2024 looks pretty good, obviously, even with a little bit of volatility. So as it concerns the election itself, most folks are expecting a nail biter. If you look upper left, you'll see those few states that really put Donald Trump over the top 8 years ago, and he only won those 4 states by 77,000 votes. And then if you look at 2020, Wisconsin, Georgia, Arizona, less than 43,000 votes delivered those 3 very important states to Joe Biden. So it's most likely going to come down to another 6 or 7 states this time around, and that's why I live in the Commonwealth, not the state. The great Commonwealth doesn't sound as good as the great state of Pennsylvania, and I can't even tell you how many ads I am seeing on terrestrial TV, on YouTube. Whenever I open my phone, it's obviously a big prize. North Carolina, Georgia, Wisconsin, Michigan. If you live in a solidly blue state, you're probably not seeing much, and if you live in a very solid red state, you're probably not seeing much. So say a prayer for all of us in those 6 or 7 states, because it's pretty wild. Next slide, please. And these are the states that matter. I'm a big fan of realclearpolitics.com. I think it's a great clearinghouse for all things politics, both reporting opinion pieces from both sides of the aisle and polling aggregation and betting market data as well. And so as of today, Donald Trump has a very, very slight lead in the average of those 7 state polls. Again, Arizona down through Georgia. Most folks, again, think that's where the Electoral College will be won or lost. The popular vote is secondary. And right now, Donald Trump is slightly ahead of Kamala Harris when you look at those 7 states and average them out. Next slide. One of the great things about this country is you can bet on anything. And if you go to Predict It or any number of other political betting sites, you'll see where people are actually putting their money as it concerns Kamala Harris or Donald Trump. And these betting sites have garnered a lot of interest and attention ever since they got stood up. The idea being that pollsters often get it wrong. People aren't comfortable telling pollsters what they really believe, so the data is going to be off. People don't respond to pollsters the way they once did. you know, in an era where no one has a landline anymore, a few people are willing to answer their front door. So betting markets, you know, are considered to be a little more predictive because people are, in theory, right, having skin in the game. And right now they're essentially tied. Kamala Harris had a nice bump coming out of her debate with Donald Trump. That lead continued to come in. And what's interesting is post the J.D. Vance, Tim Walz debate, those lines essentially collapsed on each other. So the polls are super close, and the betting sites really couldn't be any closer either. So if you want to try and figure out who might win the White House, you can do worse than consult the stock market. You know, we've talked often about the market being maybe the closest thing we've come to in terms of a crystal ball. The idea being that all these people come together on a daily basis and they decide what things are worth. And that sort of amorphous, massive amount of activity can tell you sort of which way the proverbial puck is heading. I think the great example is the stock market bottomed in March of 09, while the economic headlines were still quite dire, but the market was pricing in better times to come. So if you think about it that way, the misery index is a pretty good predictor. The misery index is the unemployment rate and the inflation rate put together. When that's high, understandably, people are unhappy. When it's low, on balance, people should feel better. And if you go back to the last 16 presidential elections, when that number is sub 7.4, the incumbent party has won. So the misery index has predicted 15 of the last 16 presidential elections. When it's below 7.4, the incumbent party wins. When it's above that, the party out of power wins. With the unemployment rate at 4.1% and the CPI sub 3, that number is now sub 7. If we were to update the slide today, so if you're Kamala Harris, you'll take that data set any day of the week. If you look at the next data point as it concerns the street and the election, there's Wall Street's fear index, known as the VIX. Doesn't measure fear, it measures volatility. Whenever the VIX is spiked early in the summer, the incumbent party tends to hold on to the White House. When it spikes late in the fall into the election, the incumbent party tends to lose. We had a huge spike in the VIX late July, early August, when the market buckled a bit on that weak July jobs report. It's come in meaningfully, but it's moving a bit higher. So if you're Kamala Harris, you're hoping that spike in the summer was it. If you're Donald Trump, not that you're rooting for tough times for investors, you'd probably be pretty happy if you got a spike, because that would tell you that Wall Street may be sniffing out a victory for the challenger as opposed to the incumbent party. And there should be one more data point, and this just ties back to the stock market broadly. So if you go back 100 years, whenever the market's rallied 90 days out into the election, excuse me, as measured by the S&P, and the S&P could be up 1 point, it could be up 1,000 points, though the S&P has never gone up 1,000 points in 90 days. But if it's positive, the incumbent party's held on to the White House. It's got when it's positive or negative, it's predicted the outcome 83% of the time, meaning when the markets are up over those 90 days, the incumbent party has tended to win. When the market's down, the incumbent party has tended to lose to an extent that's greater than what the market has historically done in terms of returns. And right now, using August 7th as a jumping off point, the S&P is positive, high single digits. So again, if you're Kamala Harris, you'll take that one as well. That all said, we've just lived through a very unusual 4 years. We're living through a very unusual, unprecedented now at this point, I'd argue, campaign season. So I always take all market historical data as helpful as it can be with a grain of salt. And I think maybe this time around, that grain of salt's a bit bigger than it's typically been. But those are some things we're paying attention to. In terms of winners and losers, from a stock market perspective, more specifically from an industry perspective, we believe that if you're president and you want to do big things, you have to have Congress with you, right? So that means if Donald Trump wins and he wants to do big things, the Republicans have to take the other end of Pennsylvania Avenue. If you're Kamala Harris and you want to do big things, you need the Democrats to take the House and the Senate. By way of example, we got the Tax Cut and Jobs Act with Donald Trump and the Republicans in 2017, and we got Obamacare with Barack Obama and the Democrats 16 years ago. So some of this is early, it's speculative, but at a high level, most folks think under a Trump presidency, defense spending, which would transcend any ongoing aid to Ukraine, would go up. The oil and gas industry would benefit from a much more benign permitting backdrop. And our business, financial services, would do well from a lighter regulatory touch. On the other side of the aisle, a Harris win would likely favor multinational companies, maybe a more benign or more certain trading global trade construct would be in place, green energy stocks for sure, and most likely healthcare companies tied to additional funding for the Affordable Care Act. But again, that assumes whoever wins the White House has Congress on their side, and I'm not so sure we're not going to. I'm not so sure we're looking at a unified Congress. I think the odds favor a divided Congress once again. Would be my 2 cents. But if we go to the next slide, and we've got.
Tim,
sorry, go ahead.
Real quick, let's keep it on that for just a second. So, because this does, I want to address one of the questions, and there are 3 questions in there. Promise we'll get to them. I'm waiting for a few more slides to get to the first 2, but the third one here talks about, like, why would we talk so much about the presidential election? For a long-term investor, this doesn't matter that much, right? And the answer is absolutely correct. Like, for a long-term investor, your job as an investor is to think about your long-term goals and your long-term structure of your portfolio. Our job as your investment manager is to make adjustments around the edges of that. So here you see different types of these companies. You see on these 2 columns, if Trump wins or Harris wins, some of these are going to be more value focused. Some of these are going to be more growth focused. Some of these are going to be in different sectors. And our job is to think about that. And this may sound crazy, but our job is to obsess about the tiniest detail about your portfolio. So we might decide to increase or decrease value versus growth stocks by 1% of the overall portfolio. Something that on a large scale is not going to change that much on a 10-year window or a 20-year window of investment. But that ongoing activity, we believe, will help minimize risk when possible and potentially, give us a little bit better return over time. So, but what I'm trying to say is, like, that comment is actually very savvy. Like, the reality is this doesn't really matter that much in the short term.
Yeah.
But
go ahead, Zach. No,
I was just going to say it matters to us.
Yeah.
Because it shouldn't matter to you, but it does matter to us because you've hired us to care. You've hired us to think about this, and you've hired us to, even when it might improve your situation only a little bit, you've hired us to think about that and care about that and execute on that.
Yeah, no, I think that's really well said. And what the comment I would make would be, I agree 100%. Politics should not be consequential to the market outside of short-term volatility, which could be driven by investor sentiment, right? We buy and sell securities for all sorts of reasons, and often the wrong reasons, right? And so one of the reasons why we want to talk about this, and clearly the person who asked that question already knows how to think about this, is to frame some of that, right? The emotional angst that comes from one half of the country sort of yelling at the other half of the country and trying to provide some perspective so we don't do things as investors that we would regret, a little bit down the road. Where this becomes a little more consequential at the portfolio level, and I think Zach said it really well, is the way I think about it is when one succeeds at politics, one gets the right to set policy. So knowing what industries might be in favor or out of favor, depending on the outcome ahead of time, can help us frame that sort of thinking and be ready to make necessary adjustments if and when the time comes. So politics should, outside of near-term volatility, prove to be inconsequential. But if you win at politics, you get to set policy. And so if you're Barack Obama, you come closer to national health insurance than any president has ever come to that point since Harry Truman talked about healthcare funded by the government. Or if you're Donald Trump, if you sort of shock the world and you win in 2016, the corporate tax rate goes from 38 to 21%. And you see this massive lift in after-tax profit. So I think those are 2 ways to think about it, put it in perspective, context, but then to Zach's point, as you transition from campaign season to governing, that's when, it becomes real. And you I think should consider the political or the policy construct or framework and how that might impact the market.
And what I really want to give credit to your question because it's 100% right.
Yeah,
like it really
for
doesn't
sure.
matter that much in the long run. What Ryan covered in the first section about interest rates, inflation, the Federal Open Market Committee making decisions, what are they likely to do? How does that impact the bond market, which has more money? I mean, all of those things are more important than this from a long-term perspective on what your portfolio will do. They're also harder to understand, and they're harder to follow, and they're harder to connect the dots between this affects that, but they definitely matter more.
Yeah. Good point. Should we go to the next slide?
Yeah, I've got a couple questions, but I'm going to hold until
yeah.
you get to the slide that has some of the S&P data because it relates to that.
Sure. So if we go down one, this, I think, again, sort of back to real world consequences, the outlook for tax policy is particularly important, I think. We think because if we do get divided government, which I think the market would be happy with, right? Not saying, who I think should win the White House, but if it's Donald Trump or Kamala Harris, and you have Republicans and Democrats sort of sharing the Congress, one party wins the Senate, one party wins the House. We'll talk about what gridlock has historically meant for the street or for investors. I think that'd be pretty well received. I think markets tended to have historically done well when you got divided government. But if gridlock means nothing gets done, and we'll talk about why markets tend to favor that backdrop, you are looking at the expiration of the 2017 tax cuts at the end of 2025. So we've got more than a year. It's New Year's Eve 2025, but that could prove meaningful for after-tax profits if the corporate tax rate goes from 21 back to 38, and marginal rates go up for many, if not most Americans. So that's something that we think is a big deal, and something we'll be paying very close attention to because of its potential implications for profits. And ultimately, as Zacc pointed out, interest rates, earnings, that's what drives markets. So if after-tax earnings are going to be down a little bit, we'll have to think about what that might mean for the markets and for portfolio construction. But we've got a lot of time between here and there.
One comment, just real
Yeah.
quick on that last slide. I know Zacc mentioned about us looking at policy, about us looking at how things affect the markets and making slight tweaks in your investment plans to try to take advantage and lower risk and potentially make a higher return. Another thing when it comes to all these tax policies, those are things that we as Capita, and especially your financial advisors, are looking at and trying to understand as they come out to try to provide our clients with the best financial advice we can. So different candidates or different policies provide different tax cuts or different windows or different tax rates or different options for Social Security taxes or whatever the policy may be. Those are the things that your financial advisors are looking at when it comes to these election events, looking for those ways that they can provide additional value to clients. And one of the reasons why we talk about them is so that if your advisor comes to you and says, hey, so-and-so just roll out this new tax savings or this methodology that we can use now. I mean, this is why we come to you with new or exciting things in your portfolios when we have our meetings with you. So I think when there are elections, I get a little excited because it means the potential for change, which means the potential for more creative ways to provide value to our clients.
Yeah, no, that's a good point, especially around the tax code. One could argue that the U.S. tax code is the most powerful instrument the government has ever come up with to influence individual and corporate behavior, right? You want people to buy a home, make mortgage interest tax deductible. You'd like them to start a family, child tax credit. I mean, it's just such a powerful tool. Maybe it's a bit of a blunt instrument, but huge implications, muni bonds and the like. So I think that's really well said. So one thing no one is talking about is the debt. So my joke has been, I'm not going to talk about it either. So we can move to the next slide because this is not 1992 and Ross Perot. No one seems to care So I guess we'll worry about other stuff for the time being. So back to Congress. So I think the most important race in the country outside of the race for the White House is the race for Montana's Senate seat between Jon Tester and Tim Sheehy. Right now, the Democrats have a 2-seat lead in the Senate. You'll see that upper left, 51-49. Joe Manchin is retiring in West Virginia, the great state of West Virginia. That seat will go red, and that gets us to 50-50, and Jon Tester is going for a third term, a Democrat in a state that's gotten very red, at least at the presidential level, and he is polling about 6 points behind Tim Sheehy. So if one is worried, and I'm not saying folks should be, that maybe the Democrats take the White House, I think the odds are pretty good the Republicans take the Senate. If I was a voting person, I would think the Democrats would take the House because of some redistricting decisions made, particularly in North Carolina and New York the last couple of years. So it's a long-winded way to say if Jon Tester can't hold on in Montana, and it's not looking like he will, at least as of now, I think that chamber flips, which I think is a very, very big deal, because to do big things, you need Congress, and you would most likely have divided government again on that end of Pennsylvania Avenue, in my opinion.
That's one of the questions in here, by the way, Tim.
Okay.
Like, how likely is it that any of their big economic ambitions can come to fruition if they don't control both houses? And it seems, at least what we've found, is that it's actually less likely to see change, obviously. I mean, that's pretty obvious that there's less change if you don't control all three parts of it, the White House and Congress and Senate. But maybe can you expand on that a little bit more?
Yeah, no, I think that's right, and that's well said. And there's a saying in DC that personnel is policy. So, if you're an administration and you want to do big things, but you don't have Congress, what you most likely do is issue any number of executive orders. And the regulatory state, the Food and Drug Administration, the Federal Trade Commission, the EPA, the SEC, will reflect the president's thinking, and will either maybe be quite aggressive about the private sector, or maybe a bit more hands-off from a enforcement point of view, from a regulation point of view. By way of example, new permits for domestic oil and gas exploration. What the EPA has to say about that, the DOE, the Department of Energy, is huge. So what you tend to see is executive orders and regulatory fiat replace big legislative wins, because they just can't get them done. So the president can still have a huge impact on the economy, but what happens is those things are easily unwound. So when Joe Biden stepped into the White House, I think he spent his first week doing nothing but signing executive orders that unwound the executive orders that Donald Trump signed 4 years earlier. So if you don't take Congress, it's really hard to do anything big from a fiscal policy perspective, meaning new spending programs and big changes to the tax code. So you'll do what you can with executive orders and the regulatory state, but all that, while meaningful, can get unwound, and historically has been unwound when the party out of power takes the White House back. Again, I think gridlock would be welcomed on Wall Street. If you look at the slide up on the screen, if you look left to right, over 90 years or so, markets have done better with a divided Congress. Doesn't matter if a D or an R sits in the White House. Again, I think what makes gridlock trickier in 2025 is what happens to the tax code. And do you see a meaningful reset in corporate and individual rates? And I do not think that would be welcomed on Wall Street. I do think there'll be some horse trading if it is a divided government, and they'll kind of meet in the middle. But I think there will be some sort of a headwind for corporate profits going into 2026. So I'm not being dismissive of that, but we will cross that bridge when we come to it.
Hey, Tim, let's do that. If you don't mind, I would love to get into Tyson's section around portfolio structure and change things like that. We go back one slide. I'm going to just make a couple comments, and then we'll move forward with some questions and then dive into that. And then, so just real quick, you guys can see that the best outcome for the S&P 500 has been a divided government. So the market, as much as Tyson over here likes change, the market does not. So the market does not want change. And it's easiest to predict that there will be little change when there's gridlock. So the market doesn't
Yeah.
mind it. The market doesn't mind gridlock at all. Will you go forward 2 slides real quick, and then let's hit one of the questions is, and I know this is important. This is that longer term comment. You know, over time, markets are positive regardless of who controls the House, or sorry, who controls what part of the government and the White House. But let's answer this question around S&P 500 investing is popular, valuations are high. How likely is that to continue?
So if you're asking me, so the S&P trades 21 times forward earnings. That is expensive relative to its history, even over the last 10 years or so. 18, 19 has been sort of more of a median PE. I think it depends, not to punt on this, I think it depends on 2 things: the trajectory for interest rates and inflation over the next 12, 24, 36 months. If that's down and to the right, or I guess, or down and to the left, depending on how you're thinking about it, lower rates lower rates are supportive of higher multiples. And then productivity gains. Productivity is the secret sauce for the U.S. economy. Over the last over the last 12 months, productivity has grown north of 2.5%. If you think of GDP being people and productivity, labor and productivity, you're already, you know, most of the way to 3% GDP handle just based on productivity. So if AI proves out to be as meaningful as people think, and some of these other productivity gains continue, markets should continue to do fine. Productivity is a huge part of it. Interest rates are a huge part of it. So those are some of the things we pay attention to at a very high level, if that makes sense.
Love it. Okay, and then let's hit the one real quick, and this might be you, Ryan, but previous data shows many positive categories. However, many business smaller owners would challenge the positive data versus true consumer feelings about inflation and the rising cost of life. How does that reconcile in the next 6 to 8 months?
Well, I think the question is spot on for how everybody's feeling. I mean, we all collectively took pay cuts over the past 2 years while inflation rose and our paychecks didn't keep up, and profits for businesses didn't keep up as well. I think the easiest way to kind of get, you know, around that is to just get comfortable with prices and hope that the Federal Reserve's actions that they did to combat inflation are a little bit sticky, and we see prices just go sideways for a bit.
They're not going down, though. I think most of the time they go up, and then it's a new watermark, and it's just going to hang there until
Yeah.
hope that it stays before it keeps going up, right?
Yeah, I mean, if they go down for a little bit, I think the Fed would be okay with that, but they certainly don't want to see prices go down over a longer period of time, because then you have a dynamic called deflation, and deflation is pretty scary. So we don't want to go down that road, because it's always best to have incentives for, you know, people to work hard, companies to make products and services, and keep prices going directionally higher, so you have that productive workforce and output of a country. So that's really important to keep inflation positive over the long term. Over the short term, I think everyone could use a little bit of a breather. I think the Fed's actions at least keep prices going sideways for quite a bit, and hopefully that plays out and everybody gets a little bit more comfortable with current price levels.
One quick comment on that. I know that first graph that you showed the peak around 9%. Now we're down to about 2% of inflation.
Sure.
I just want to reiterate, that is not, prices haven't fallen that amount. That is the rate things are getting more expensive, right?
Yeah.
So things are getting more expensive slower now. So yes, individual consumers are still feeling the 9% from, you know, and the big rates from last year before. And so, yeah, it's like Zacc and Ryan are saying, where things aren't likely to get cheaper, but we're hoping they just don't get more expensive faster than earnings can grow.
So
Very well said.
one question about the windfall elimination provision. I'm going to respond to you directly. That is the audience here. There's so few of you subject to it that, and for time's sake, I'll respond back to you individually. And then maybe Tim or Ryan, before we jump into Tyson's section, the one person said, I would like to talk about debt. Can you give us like the 30 seconds of how does the debt matter?
Yeah, so my 30-second version is if anyone tells you they know when U.S. debt outstanding is going to be a meaningful drag on the economy, or sort of, you know, signal the end of days for the U.S. Economic experiment, they're fibbing. They don't know. No one knows, myself included. I do think, though, we hit an inflection point recently where, because of higher interest rates, debt servicing costs, meaning sort of like, think of this as your credit card balance, and then you have to pay to service that credit card debt, got to the point where we're spending as much on debt servicing costs as we are on defense. That's a big deal. So lower rates not only help consumers and companies, they would help the U.S. government for sure, because we are at a point where you're spending as much to service your debt as you are on the military, and then you obviously have Social Security, Medicare, Medicaid. There's not a lot of money left over after that for general discretionary spending. So I don't think the absolute level of debt is an issue. At least it has not been yet, despite, you know, sort of historically high levels. I do think debt servicing is an issue, and the federal government, like the rest of us, would benefit from lower rates. So if the Fed can keep cutting, that should end up being a net positive in terms of the government's fiscal position year to year, if that makes sense.
Yeah. All right. Thank you, Tim. Zacc and Tyson, if it's okay, I'm going to hand the baton over to Tyson. I had planned on covering some evolution of asset allocation to the cornerstone models, to show the history of what we've done in managing those models over the past couple of years. I think, to give Tyson the sufficient amount of time, perhaps maybe you want to invite everyone to get in contact with you after the call if they want to review that.
For sure.
We also have our current positioning that you can share with them as well on this slide here. But let me hand it over to Tyson, who's been very patient. I think Tyson is going to walk us through some highlights on some of the third-party SMA managers that we use.
And then if, Tyson, if you can, or Ryan, maybe just tell us generally, a lot of our clients do have the asset allocation cornerstone model, so maybe like a quick 30 seconds on that too.
Yeah, I would say the quick 30 seconds is we continue to lean a little bit into, we continue to lean into risk, but not a ton. We're mindful of valuations, we're mindful of earnings growth, and we're also mindful of what the Fed is doing. We've done a really good job, I think, over the past couple of years on the fixed income side of things and managing around rates. On the equity side, it's been a little bit more mixed. We've done good leaning into growth style sector, tech, and the US. The things that have slowed us down a little bit in terms of your portfolio return has been primarily our overweight to small and mid cap companies. And the reason there is, we thought the timing of when the Fed was going to cut was going to be a little bit sooner. And when you have a Fed cut, it tends to open up a nice tailwind historically for those smaller mid cap companies. So we'll be much more mindful of that dynamic going forward in the next couple of quarters now that we've seen the Fed cut. So that's kind of the 30-second snippet there.
Perfect.
Tyson?
Yeah. Sounds good. Thank you. Yeah, and if any questions around the asset allocation decisions, just let Ryan or myself know, and we're happy to talk through it as well. But on these slides, I just wanted to take a few minutes to go over some of the themes that are being explored by a lot of the portfolio managers that we use on the platform, and what's going on inside of the portfolios that you hold. And so starting here on the growth side, we're looking first on the left side with Poland Focused Growth. So that's going to be the U.S. large cap growth manager. They are a manager that historically, they've been around for a very long time. They've been running this portfolio and this strategy for over 35 years. And they focus on finding companies in the space that have a high earnings growth rate. So when you look at the overall index, the index is usually going to be growing their earnings at a rate of around 9% on average historically, where Poland is trying to find companies that will grow their earnings rate at the mid-teens, around 14, 15%. And that's really been a really positive for their performance and returns historically. Right now within that space, Poland's really optimistic about their current positioning as it applies to generative AI. That's one of the themes that Tim talked about with productivity, and definitely one of the largest themes that's being explored within the marketplace in general. When you look at generative AI so far over the last 18 months to 2 years, you've been seeing mostly just the producers and the hardware companies that have been really gaining traction, market share, and growing as far as performance. Poland feels that is something that you could draw a parallel to the .com era. when you looked at the start of the dot-com bubble, there were companies like Cisco, Corning, Sun Microsystems that were doing servers, fiber optic cables, things like that were more hardware intensive for the building up of the internet. And those companies performed extremely well. But over time, the market made the mistake of extrapolating out those really high earnings growth rates into the future for companies that are a little more cyclical and less recurring revenue streams. And when you look back at that, those companies struggled as demand started to fall, but the people who actually had the best long-term performance were the Amazon, Google, companies that were focused more on creating more sticky business models using the new technologies. And so that's what Poland is focusing on. They're looking for companies that are going to have recurring revenue using AI, companies like Google, Microsoft, some of the larger tech companies. And they right now are calculating about 50% of their portfolio will have meaningful recurring revenue from generative AI. And so really positive, really happy with Poland and their positioning. And I'll quickly run through some of these other ones. So when we move down into the cap space, into Congress, SMID growth, so these are the smaller cap companies. Ryan and Tim talked a little bit about how when interest rates fall, that can be a headwind or a tailwind for smaller cap companies, since they're more sensitive to the cost of capital, and they usually require more traditional forms of lending in order to fund their growth. And so when interest rates go down, they tend to do a little bit better than their large cap counterparts. Within the small cap environment, both of these managers are focused on quality, meaning that they're looking for companies, companies that will take a prudent approach to debt and hopefully not go overboard on leverage and debt. And as we see rates come down, they're still not going to hit the pre-COVID levels of near zero. And so they think that focus on quality, profitability within the small cap space, mixed with the tailwind of rates coming down, but still being slightly elevated from historical norms, is a great combo for them to perform very well moving forward. And so if you want to go to the next one, I'll just touch maybe 30 seconds on this. With dividend equity, another area where with declining interest rates, dividend yields start to become more attractive when other interest-bearing investments like bonds start to be issued with lower yields. And dividend equity managers is a space where you can get some diversified income in income-seeking portfolios. And so it also attracts more capital as the dividend yield starts to look more attractive. And so it's another area to pay attention to. With that, pass it back to Ryan and Tim.
So let's do this real quick, if you don't mind. So everybody listening, just so you know, most of you have a cornerstone model, an overall diversified approach to investing that allows you to have a lot of low-cost index funds within the portfolios. And then you also may have some of these individual managers in your accounts as well. So we asked Tyson to show some of the recent activity from these managers so that you got a little bit of a flavor for all the work being done behind the scenes on the individual investment selection by each of these managers. Now, Logan, Dearborn, St. James, Kane, Congress, Poland that we saw on the previous slide, they are all additional professional money managers that we go out with Orion, especially. They do a lot of this work and find the best of the best across the world and hire them, get their trade signals and implement those directly in your portfolio. So it's a way of being more efficient. So that was the idea behind showing this to you. We are done with questions. We're at the time. I feel like this has been super helpful. Ryan, Tim, Tyson, anything that you guys feel like we want to talk about, share in the end before I wrap us up?
One quick comment I would make, right, as you step back and you've got this unsettled situation in the Middle East, you have an election less than a month away, rates are being cut. We just finished up Q3. The third quarter, we'll get Q3 earnings soon. Profits look to be growing. China, like or dislike from a geopolitical perspective, is trying to stimulate its economy. So at the risk of sounding too Pollyannish, and once we get through the election, markets tend to do well, and we're in the seasonally strong period. If you want to take an optimistic view of things into year end and into 2025, there's some pretty powerful tailwinds that have shaped up and are shaping up, even though I know markets have already done really well. Again, a backdrop of rising profits, falling rates, the world's second largest economy trying to kickstart growth and getting through the third very contentious presidential election we've all faced as a country, I think, those are some pretty positive boxes to check off.
Perfect. Here is our phone number. You have an email address, our website. I mean, obviously, if you're a client already, you know your financial advisor, but feel free to reach out to them if you feel like you'd like to know better how this applies to you and which of these strategies are implemented in your portfolio. The overall thought process is implemented across all of the portfolios, but it might be nice for you to get a feel for the individual accounts if you'd like. And of course, we're happy to answer any questions. We're here for you. It's a big deal that you trust us, and we appreciate that and understand that. So we're glad to have you. And I love that there are some regulars here that always join and make these sessions so engaging with your questions. Thank you very much. And with that, we'll wrap it up.
Yeah. Thank you very much, Zacc and Tyson, and
Thanks.
everybody else. Have a great day.
Thank you.
Thanks all.